Top 10 Stocks to Invest. Hey folks, I'm back again with yet another awesome video. Today's video is all about the top 10 stocks that you should invest in 2021. Listen guys, I got a jam-packed video, so hang out with me all the way through this video, and please make sure to subscribe to the channel. We all know how the stock market in 2020 was dropped roughly by 34% in just a single month. But then the government reacted quickly with the multi-trillion-dollar CARES Act. In 2021, the fate of the economy, and especially the stock market, will likely revolve around the pace and effectiveness of factors like the vaccine rollouts for COVID-19, along with financial stimulus and government assistance programs. Don't you think? And obviously, all this comes with a new White House administration running the show. Guess what? As nations race to reach the coveted post-pandemic phase, themes like technology, penny pinching, entertainment, and personal health run through the best stocks to buy for 2021. So, without any further ado, let's get into the video. Number 1. Adobe. This cloud-based software-as-a-service model with a grip on the creative software market has only grown with time, ensuring high-margin, recurring revenue from its dominance well into the foreseeable future. Adobe, as we all know, is into online publishing, film, photography, digital advertising, graphic design, and digital documents. And it's no wonder it's considered best-in-class in its industry by a country mile. Now, the question is, why should we invest in this stock? Let me tell you, among the 10 best stocks to buy for 2021, Adobe has the highest gross margin at 86% and boasts the second best net profit margin at more than 31%. This is a great one to go for. In areas like revenue and cash flows, it has set record after record in 2020. And not to forget, its double-digit revenue and growth continued. Number 2. Spotify Technology. It's fair to say that Spotify is the only company on this list that's not quite yet consistently profitable. Through shared playlists, the company has successfully turned digital music into a social experience. Its investment in the future of podcasts became apparent in 2020 with an original podcast from former First Lady Michelle Obama. It also signed podcast giant Joe Rogan in an exclusive multi-year $100 million licensing deal that could bring in millions of additional subscribers. So, why invest in this stock? Analysts currently think the company may take until 2022 or 2023 to break into the black. In the meantime, it is growing in popularity aggressively. Its monthly active users jumped 29% over year to year to 320 million last quarter, while the number of premium subscribers rose by 27% to 144 million. This has a great scope in the future, but more conservative investors should consider the risks on that front before investing in this stock. Number 3. BJ's Wholesale Club. The company's most prominent public competitor is Costco Wholesale, which is more than 30 times the size of BJ's. That alone gives us an indication of the size of the market. BJ's has 219 locations when compared to Costco's 803. But nevertheless, it's growing same-store sales more rapidly. Last quarter, comparable sales rose 18.5% year over year. Digitally enabled sales helped them on that front, soaring around 200% year over year. At the same time, BJ's trades for just 14.5 times earnings, or about 1/3 the price-earnings ratio of about 42 for Costco shares. This is just incredible. Number 4. The Walt Disney Company. After Spotify, this is technically one of only 2 names among the best stocks to buy in 2021 that's not profitable. To consider Disney's valuation, think of Disney Plus in an isolation for a moment. Shocked? It's a fact that Netflix is the largest standalone streaming service in the world. It's worth about $225 billion and has built up about 200 million subscribers worldwide since its launch in 1997. Disney Plus, on the other hand, has only existed since November 2019 and already has nearly 75 million subscribers globally. Disney, which is worth about $279 billion, also has its studio entertainment, media networks, and parks, experiences, and product segments to boot. Analysts expect Disney Parks and Cruises to hit operating income, but only for its budgeting streaming platform to become more and more material. In short, Disney is a high-quality blue-chip stock at a good value, so there's no need to worry about the long-term money-making potential of the House of Mouse. Number 5. Facebook. It's more or less tradition now to include Facebook among the annual list of 10 best stocks to buy. It's always been an investor's pick for a long time, with shares up 172% since first being named in 2017. For comparison, the S&P 500 is up 85% over the same period. FB is a singular company due to its unpredictable scale and user engagement. Its Facebook platform alone has 2.74 billion, while monthly active people on its family of apps, which also includes Instagram, WhatsApp, and Messenger, is at 3.21 billion. Facebook barely edges out Adobe as the stock on this list with the highest net profit margin at 32%. And opportunities to boost monetization through e-commerce. Facebook Shops, Facebook Marketplace, Facebook Dating, and other areas like virtual reality offer several long-term growth drivers. Number 6. Alibaba Group. Alibaba, like Facebook, is a returning pick for many investors over the years. It's massive, worth more than $725 billion. And sales rose about 30% last quarter, which indicates its rapid growth. In a year that saw a pandemic emerge, spread, and shut down day-to-day life in much of China, Alibaba kept growing, and its stock is up about 25% year-to-date. Although it's most notable for being Asia's preeminent e-commerce giant, its cloud computing division now accounts for 10% of overall sales and enjoyed revenue growth of 60% last quarter. At 21 times forward earnings, Alibaba stock still trades more cheaply than most large-cap growth stocks. U.S. investors should have some exposure to Chinese companies, and Alibaba is arguably the single safest bet. Number 7. Lowe's Co. Lowe's takes the cake over its larger rival, Home Depot, for a few simple reasons. Its size leaves more room for growth, and analysts expect higher growth over the next 5 years to boot. Home improvement retailers stand to continue a solid 2020 run into 2021, as the pandemic incentivizes homeowners to remodel and improve the houses they're spending more and more time in. Why invest in this stock? Analysts are calling for compound earnings growth of more than 20% over the next 5 years. An incredible pace of growth, particularly for a company trading at just more than 21 times earnings, roughly half the 41 times earnings the broader S&P 500 trades at today. Number 8. Sonos. Sonos, as you know, is a consumer electronics company focused on wireless audio technology and the smart home. It directly relates to 2 other picks on this list, Spotify and Lowe's, by tripling down on the expectation that home improvement and home entertainment have become increasingly important to consumers. Sonos, with a $2.4 million market cap, stands to benefit from a continued boom in demand for home entertainment systems, as the outlook for movie theaters is still gloomy entering 2021. Sonos demand should have more than just 1 quarter's worth of runway, however, and the company should even be an acquisition target for companies like Alphabet, Amazon, and Apple, which are fighting for ground in the connected home market and the Internet of Things. Number 9. Newmont Corp. Last among the best picks for 2021 is Newmont Corp. It has always been a repeat pick for many investors since the past few years. The gold, copper, and silver miner is an excellent hedge. Gold especially tends to perform well as a safe haven asset during recessions, though it has been a rough year for the global economy. Although shares rallied in 2020, Newmont still looks attractively valued, with a P/E around 21 and a 5-year earnings growth expected to exceed 36% annually. Newmont currently has a 2.6% dividend yield and will have repurchased $2.5 billion in stock throughout 2019 and 2020 when the year comes to a close. Newmont expects its all-in cost for mining an ounce of gold will be $970 in 2021, so it would take a steep plunge from gold's $1,800 to $2,000 levels to turn Newmont unprofitable. Number 10. Tilray. Keep an eye on this boom or bust risky stock. The best investors in the world have an extremely keen sense of the risk-reward trade-off. If you could boil down one trait that makes great investors so successful, it would be the ability to maximize the ratio of reward to risk. That said, sometimes very risky stocks can still offer impressive potential returns by comparison. Many of the discussed stocks are a great fit for conservative retirement investors. But this stock is rather more for aggressive investors with longer time horizons. Tilray, like many of the marijuana stocks, is a quintessentially risky boom or bust play. The Canadian marijuana company was primed to be one of the major beneficiaries when Canada legalized recreational marijuana in 2018. And there's no doubt that was a major boon to Tilray's top line. Revenue soared 110% that year compared to the prior year and increased 287% in 2019. And sales soared from $12.6 million in 2016 to $167 million for a full year 2020 revenue. Unfortunately, Tilray's losses have expanded with revenues, and the company's lost $321 million on $167 million revenue in 2019. As for the potential boom, the stock is down 65% year-to-date and may benefit from a speculative run-up since former Vice President Joe Biden, the more cannabis-friendly of the two major presidential candidates, won in November.